The rise in the American stock markets continues. The main driver of this rise is artificial intelligence. Last week, 4 major earnings reports were released. These were the hyperscaler earnings reports, which are highly relevant to artificial intelligence. In other words, 4 companies that are making massive investments in AI and building data centers: Meta, Amazon, Microsoft, and Google. The market really liked Google. It didn't like Meta at all. The market was somewhat undecided about Amazon and Microsoft. Microsoft was also viewed a bit more negatively. So what do these earnings reports, or rather the statements from these companies, tell us about the future of artificial intelligence? Where are the new investment opportunities? And what is the danger facing companies like Nvidia, which still holds the largest share in my portfolio? We will analyze all of this together with you. Whether you're an investor or not, where is artificial intelligence headed? Where are the world's largest companies headed? I think all of this will be very interesting to you. So, if you're ready, let's take a deep dive now. I can guarantee you this will be an analysis of a quality you won't find anywhere else.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
As always, I've prepared a presentation for you. While preparing the presentation, I made use of artificial intelligence and fed it content from dozens of sources. Then, Notebook LM created a wonderful presentation draft for me. By working on it over and over, it became exactly the way I wanted. The name of the presentation is Big Tech Q1 2026, AI Profitability and the Silicon Revolution. This will be a presentation about the explosion of cloud margins, the rise of custom chips, and how consumption-based models are rewriting the rules. First of all, those who have been following me for a long time already know this. There was an issue I was worried about. I wondered if artificial intelligence would reduce the profit margins of these hyperscalers. Because these companies are moving away from being purely software companies. Take Meta, for example. It's an extremely lean company. In other words, they're shifting from companies that require little capital and make money from software and advertising to becoming hardware firms. This is especially striking in Meta, Microsoft, and Google, because they're spending enormous amounts of money. While previously they were making money without spending these amounts, now they have to pour money into infrastructure. Will this reduce these companies' profit margins? Will it disrupt their cash flows? There were quite a few concerns about these issues. That's why I've been staying away from hyperscaler investments for a long time. At the beginning of this year, I had Meta and Amazon. Then I sold those as well. I was waiting for these financial statements, and honestly, these reports have somewhat changed my perspective. First of all, we need to talk about a misconception in the market. AI workloads have lower profit margins compared to traditional cloud systems. For example, think about Amazon. Amazon Web Services has been around for a long time. Or Microsoft's Azure or Google's Service, they all have them. We were worried whether their profit margins would decrease, because artificial intelligence is much more expensive. It consumes more energy, uses more compute resources, and at the same time, there are depreciation costs involved. But as far as we can see, that's not the case. Despite massive infrastructure investments, this is called CapEx, the profitability of tech giants doesn't seem to have diminished much. So when we look at the first quarter of 2026, we saw accelerating growth and record profit margins. AI workloads haven't squeezed profit margins. They've actually increased them. The Microsoft management says this about the issue. The profit margins in our AI business are even better than the margins we saw in the early days of the cloud transition. After this important conclusion, we need to look at some trends. So what do these reports tell us? I analyzed it in detail with the help of AI as well, and I identified 4 main factors. The first is the cloud profit margin boom I just mentioned.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
In other words, Amazon Web Services, Google, Azure, all of them are achieving higher profit margins thanks to artificial intelligence. This was something I didn't really expect. A second important issue is custom chip, that is ASIC strategies. As you know, 2 types of AI chips are being used. First, there are GPUs produced by Nvidia and AMD. GPUs are chips that can do everything in artificial intelligence, let's put it that way. And then there are TPUs or custom chips. These are especially produced by hyperscalers themselves, so they don't end up paying too much money to Nvidia or AMD. When we look at that side, there is a significant boom in TPUs or custom chips like Amazon's Trainium, and these have now become products not just for internal company use, but also for sale to external customers. We will focus on this. A third point is that, as you know, among these 4 companies, Google and Meta earn money directly from advertising revenue. That's their main source of income. Amazon earns money directly from advertising. At the same time, it also makes money by properly showcasing its own products to customers. So maybe that could also be considered advertising. Microsoft, on the other hand, isn't really involved in advertising. But we've seen that there's a significant artificial intelligence revolution happening in advertising. When we look at the financial results, we see that all 3 companies have experienced significant revenue growth in advertising thanks to artificial intelligence. So It wouldn't be unfair to call this an AI revolution in advertising. And the fourth topic is that the pricing system is changing. While there used to be fixed pricing, now it's shifting toward consumption-based pricing, and this increases the profit margins of the hyperscalers. Let's first look at operating margins. For example, Google's data is quite striking.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
In the first quarter of 2025, the operating profit margin in Google Cloud jumped from 17.8% to 32.9%. That's an incredible figure. So, on one hand, the company is growing. Revenue from the cloud side has reached $20 billion. Revenue from AI-related products has increased by 800% year over year. Let's look at Amazon. Amazon is a bigger player. That's why, since the base is larger, the growth rates are a bit smaller. Despite that, the company's operating profit margins on the cloud side have jumped from 31.4% to 37.7%. There's a significant increase here as well, and is experiencing the fastest growth of the last 15 quarters, reaching an annual revenue run rate of $150 billion. So yes, a lot of money is being spent on CapEx, but these are increasing profitability. Honestly, we weren't expecting this. Of course, there might be a concern like this. How is the depreciation of these chips going? Will that depreciation eat into these profit margins? Well, to be honest, they're already factored in here right now. I mean, depreciation could accelerate in the future because maybe brand new technologies will emerge and render these chips obsolete. They will have to write them off. In other words, they will depreciate them in an accelerated manner. But right now, that's not the case at all. On the contrary, all the companies are saying, we're using even our oldest chips at full efficiency right now. There's a shortage of chips, a shortage of memory. By the way, one of their common problems is the price increases on the memory side. Those are affecting us somewhat negatively, they say. The second topic is these custom silicon chips. In other words, there's a significant transformation happening in the chips these companies are developing internally so they don't have to rely on Nvidia. These are no longer just cost centers, they're becoming profit centers. In other words, they're considering selling them externally as well. For example, Amazon's Trainium, their own chip, if it were an independent company, it would have $50 billion in revenue and would be one of the world's top 3 data center chip firms. It would be Nvidia, AMD, and then Amazon. Amazon Web Services has saved tens of billions of dollars in capital expenditures thanks to its own chips. So this is leading to significant savings internally. Additionally, opportunities to sell externally are also emerging. For example, when we look at Amazon, it is claimed that in the coming years, it will generate around $225 billion in revenue from Trainium. This not only increases their own cost savings and profit margins, but also brings new revenue opportunities, and they say, I will sell customers fully equipped hardware racks. This, friends, directly means competition with Nvidia and AMD. As you know, Google has its TPUs. They are talking about an expansion into external markets that goes beyond internal company use. This has a significant impact on increasing the profit margin from 17.8% to 32.9%. These chips are both cheaper and in some areas, they also improve processing speed and cost. I'll focus on this in a moment. They are trying to sell TPUs to customers' data centers. They also have such a move. If you look at Meta, Meta does not produce its own chips. They have collaborations with Broadcom, with Broadcom's ASIC. By the way, Google also has its chips manufactured by Broadcom. As far as I know, Amazon does the same. So these companies mostly do the design. Broadcom handles the manufacturing and some detailed design work. The main chip production is still done at TSMC. Don't forget the big picture. So no matter what, they all turn to TSMC. Broadcom and AMD made a special silicon deal for 1 gigawatt to balance out the high memory costs. That's a problem. That's why companies like Micron and SanDisk have skyrocketed. There's a memory shortage and prices are rising sharply. With this new move, they want to optimize memory costs a bit. They want to balance this out. The model and the hardware will work simultaneously. This way, they say it will reduce latency and delays. So now, for these 3 companies, chip production and design have become important, not only for managing their own costs, but also as a product to be sold externally. Another issue is that advertising is changing a lot. We can see this very clearly in 2 examples. Look, Meta's advertising revenue reached $56.3 billion. That's a 33% growth compared to the same period last year. An incredible growth. Thanks to what? Thanks to artificial intelligence. What is the dynamic at play here? Impressions have increased by 19%. The average price per ad has also increased by 12%. In other words, ads are being shown to the right people more accurately. That's why the click-through rate on ads is increasing. And because of this, they can charge customers more money. When we look at the metrics, there's an 8% increase in video watch time on the Meta platform from quarter to quarter. So what about Google? What's the situation there? The results are very good there as well. Search has grown. For example, this is actually one of the things I was wrong about. I thought search could be negatively affected by artificial intelligence. But there's still a 19% growth. Moreover, this growth is coming on top of a massive base of $240 billion. Why? Because now artificial intelligence is working in the background of search queries. This increases the quality of people's searches and keeps them here even more. So in the end, the narrative that search is dead has proven to be invalid. This is one of my own misconceptions. There was another issue we used to think about, both for Google and for Meta. This AI-powered search could increase their costs. Because in the past, when you searched on Google, there weren't large language models, GPUs, or high energy consumption running in the background. A simpler algorithm and infrastructure were needed. We used to say that if all searches are done with AI, the cost for these companies would increase. They've made an innovation regarding this. They call this a smart router, a router innovation. What it does is, in a very short time, it checks and calculates whether a social media user will turn into a customer. However, it does this, again, by utilizing artificial intelligence. And for users with a low probability of conversion, that is, those who are unlikely to make a purchase, it responds with a simpler, slower model. This way, it keeps costs under control. On the other hand, if the customer's likelihood of making a purchase is high, then it shifts toward a large language model with 1 trillion parameters.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
By using their own custom chips, and there is a maximum processing cost. Yes, the cost increases, but so does the probability of a sale. Because of this, they become able to charge more for advertising. This shows new AI developments change everything. How does Microsoft see this? Microsoft isn't in the advertising sector. They are active in the enterprise software sector. The artificial intelligence division has grown by 123% this quarter. Incredible. And honestly, I used to think that products like Copilot weren't really being adopted. I mean, because there are better AI alternatives. But they've already reached 20 million users, a 250% year-over-year increase. Of course, I don't know if these people are actually using it or if they're just buying it as part of the enterprise package. But these are the results. And Copilot usage has increased by 20% compared to the previous quarter. That's how Microsoft puts it. What does this mean? For example, let's look at some software as a service companies, like ServiceNow, Workday, Datadog. Their annual recurring revenues are at these levels. $1.6 billion, 10.8, 25.7. Don't get me wrong, these are revenues coming from artificial intelligence. Microsoft's has reached $37 billion. I still look at Microsoft with a bit of skepticism. I know that the products on the artificial intelligence side aren't very well liked, but the results also tell us this. Another issue is that pricing models are changing. In the past, cloud systems actually used to finance the consumer a bit. They used to subsidize them somewhat. Users would come, subscribe for a certain fixed price, and use the cloud however they wanted. But now that's changing. We can see this in the entropy of the cloud as well. It has also abandoned that fixed pricing. They're considering removing the $20 package. The minimum package now starts at $200. And if your usage increases a lot, they also want extra money from you. So what does this do, of course? It gives these kinds of companies the power to increase their profit margins. Because the demand for IT is increasing at an incredible rate. So instead of a fixed price per seat, they're moving to dynamic pricing. Some are using a hybrid model, meaning both a fixed seat price and, as in the case of Anthropic, higher pricing when usage exceeds a certain threshold. This also increases the profit margins of these companies. This graphic illustrates that nicely. If consumption keeps increasing, the user causes you to lose money. But if pricing changes along with consumption, then you make more money. This has now become possible. Why? Because it's not enough, friends. Let me speak for myself. I use two AI tools very intensively, Cloud and Perplexity. Besides these, I also use Grok. I'm not a programmer, I'm not a software developer. I mostly use them for financial analysis and preparing presentations like this. And we offer some special management dashboards to our school members so they can manage their investments better. For example, what are the risks? What is the technical status of the stocks? And so on. Even so, there are situations where these packages are not enough for me. In other words, when the package isn't sufficient, this means extra pricing, extra fees for hyperscalers. And as we move towards agentic AI, that is from AI that only answers our questions to AI that actually does work, this demand will increase. I mentioned this before as well. Let me just give you one example. In the first quarter of 2026, the number of tokens processed on Amazon Bedrock, which, as you know, are the consumable product, the oil, the energy of artificial intelligence, so to speak, was higher than the total of previous years. It says that a large part of the value companies will gain from artificial intelligence will come through agents. And we know that agentic artificial intelligence greatly increases two things. It significantly increases overall AI consumption, and at the same time, it also greatly increases CPU consumption. Both Amazon and Microsoft are aware of this. So GPUs are very important, but at the same time, CPUs are also needed. Because when creating agentic AI agents, we still need the traditional CPUs we know.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
One of the reasons Intel stock has surged recently. The surge in AMD and ARM is also due to this. Right now, there is also increased demand for more traditional chips. So when we bring these four issues together, custom silicon, smart routing, exponential usage on the advertising side, and changes in consumption-based pricing, I think these companies have a bright future ahead. Of course, this doesn't mean that these stock prices are absolutely correct or justified. That needs to be evaluated separately. But honestly, I've let go of some of my concerns about these companies. What were my concerns? Would profit margins decrease? They are making very heavy capital expenditures. How will this affect their cash flow? By the way, their cash flows are being negatively affected. That is still a reality, and it's extremely important in the valuation of these companies. But if profit margins are constantly increasing and sales are growing very rapidly, in other words, if you're getting a very quick return on your investment, then those cash flows may become insignificant after a while and could turn positive. We've also seen some other things. Take all lock-in, which I also face. Now I do some work with AI and some outside of it. I'm moving my outdoor tasks to AI too, because I want artificial intelligence to develop a memory. I want every action I take to be there, so that when I request the next action, it can be connected to the previous one. This is a very powerful trend right now. Because of this, companies that use artificial intelligence on a cloud platform, including myself, now want to keep their data in the same location. I'm also currently uploading all my data to Claude as fast as I can. I'm uploading it to Perplexity as well, because the more data I upload, the better the insights and results I get. This is turning into a factor that makes the cloud business grow even faster. The second issue is multi-model usage. For example, I use both Claude and Perplexity. The reason is this: Claude is great for certain tasks, but Perplexity gives me access to all the AI models. It also connects to Claude, so things get sorted out over there. But at the same time, it also connects to the Notebook LLM, where I prepared this presentation, to Gemini and to OpenAI. In other words, it accesses whichever AI is best suited for the task I'm trying to do at that moment. This gives these companies, for example Microsoft, a huge advantage. On Microsoft's Foundry, you can access Anthropic, OpenAI, many other open source softwares, and even Chinese ones. This is called the orchestration layer, and I think this also seems to create a serious strategic moat for hyperscalers. And the third point is that now, instead of horizontal, there is vertical AI competition. What does this mean? Remember the advertising example. The moment someone sees an ad, you need to very quickly assess whether they will continue shopping or not, and then manage the rest of the flow accordingly. Which GPU will be used, which TPU will be used, or will they be used at all, or will the customer be given a slower experience? These are only possible if you design your hardware and software end-to-end yourself. Frankly, this also raises some questions about the future, especially regarding GPU manufacturers like Nvidia and AMD. It seems that the use of TPUs will increase, especially among hyperscalers. This is also an issue that could somewhat change my investment thesis. Because I always believed in this. Yes, TPUs are important, but the need for GPUs won't decrease either. By the way, it isn't decreasing. We'll see in Nvidia's financial statements that there's an incredible increase. It's the same with AMD because the total compute demand is increasing. That's true, but lately, due to Agentic AI, it seems like the CPU side is becoming more important.
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
Also, within these companies' own end-to-end vertical AI structures, TPUs seem to be gaining importance. So does this mean Nvidia and AMD are finished? No. Competitive advantage also depends on other factors, but the risks are increasing somewhat. We can say this for the GPU side, but don't ever forget this. I've mentioned it many times before. Overall, supply in computing is limited and will remain limited for a longer time. That's why all the companies in this field will continue to do well. What stock prices will do is a separate issue, because right now semiconductor prices seem a bit inflated. There could be corrections and so on. That's another matter. But the future looks bright for these companies. It seems that the future could also be bright for hyperscalers. I think researching and finding investment opportunities in those areas has become very important. This earnings season has somewhat changed my perspective on both hyperscalers and GPU manufacturers like Nvidia and AMD. Here's what we see. Demand is so high that even though chips and storage capacities are constantly being increased, the industry will continue to operate with limited capacity at least until the end of 2026. I think this could be extended until 2028 because usage is constantly increasing. Today, a new figure came out regarding Anthropy's revenue. Anthropy's revenue, that is its run rate, had risen from $19 billion to $30 billion. This week, it has increased from $30 billion to $44 billion. These things are growing so fast. That's why there's even more demand in these areas. As you use artificial intelligence, You see that just like in this presentation example, researching this, validating it, analyzing the data, developing investment theses and antitheses, and then turning it into a presentation, what we are able to do is truly incredible. That's why I think demand here will increase even more. So based on this, which companies look attractive from an investment perspective?
I'm picking up trash equal to my subscriber count. Do you want to join this good deed too?
I'll share that with my school members. If you haven't joined our school platform yet, sign up right away. You can try it free for 1 week. The name of the presentation there is The Age of Custom Silicon. Here's what we're doing there. The main inputs from the previous presentation, but on top of that, we also look at company balance sheets, valuations, and pricing. This is a separate presentation where we analyze what impact that presentation could have on these companies. From there, we'll look at our investment theses for the future. At the same time, we'll also discuss whether companies in our portfolio like Nvidia and AMD are still investable and how to manage risk in those areas. There is a 1 week free trial. The school link is below. Come and try it out for a week right away. If you don't like it, the decision is yours.